Good evening, thanks for watching. Today I'm working more on my stock market tool. Let me show you where I'm at. Oops. 10 of these. Crown family like the Genovese. You don't want drama, capiche. Okay, so here's where I'm at. This is the general outline. So I have two goals. First goal is to beat the S&P by a significant margin and make money in all regimes. So I want to be getting, several times higher than the S&P, 3, 4, 5 times as good as the market average. Additionally, if the market's going down, I don't want to be losing money. I want to still be, I guess a good way to say this is market neutral. But I want to be market neutral. I want to be making money if the market's going up, if the market's going down, and I want to be outperforming the S&P because if I'm not, I could just buy and hold the S&P 500. So I'm writing all of this in Python. So the second goal I have for this is to generalize the code I'm using into a model that anyone can use. I just had to make sure this is working. So I want to generalize it into something anyone can use. So the first step, I have data going back to 2011. I don't want to use all stocks that are available, so I'm isolating a stock universe. And then feeding this into a model which should predict returns. It's predicting 5-day forward returns, 1-day forward returns, returns relative to the market average, probability of going up, things like that. And then once I have a good returns model, I'm going to feed it into the portfolio model. And the portfolio model is what controls position sizing in a portfolio. So basically, it's going to automatically make long buys and short sells, and then adjust every day according to the market, according to the model outputs. That's kind of the outline of the model. I've been working on this since the end of last year, so it's been quite a while. And a week ago today, I got a really good result finally for the returns model. So here's that here. Okay, so how do I know it's a good result? First thing is that the information coefficient, this value right here, where my mouse is, was 0.0471. So my goal for this metric is 0.01 to 0.02. So it's getting way above my goal for the metric. So information coefficient is basically giving the predictive power of the model, given the information, how correlated to the real information is my prediction. So that's the predictive power of the model. If it's 1, then you're perfectly predicting the market. That's not going to happen. But for a stock market model, stock market has really high or really low signal to noise ratio. So I'm shooting for 0.01 to 0.02 and I'm getting here 0.047. These next 4 metrics, standard deviation of the information coefficient to information ratio, both on a daily and annual basis, and the T statistic. These are all also outperforming the goal metrics. And these 4 give you the stability of the model. So the fact that these values are so good is my first indicator that I have a good model. Now this is after robust testing for overfitting, data leakage, survivorship bias. So I know I don't have any of those going on. Those are all common pitfalls of stock market models. You think you have something really good, but it turns out you're only, picking things that have survived over the last 15 years. So I don't have that. I'm including stocks that have been dropped out of the stock market. So I'm confident that this is a really good model. All the metrics are performing really well. There's no data leakage, no survivorship bias, none of the common pitfalls of stock market models. The second thing here is if you look at the decile analysis, this should basically be monotonically increasing with the worst performance at the bottom decile, so the bottom 10%, and the top 10% should be the best performing. And so that's exactly what you see here. Each decile is outperforming the previous decile, and it's highest at the top, lowest at the bottom. So that's my second indicator. I have a really good model. Now, this is only on one training split. So it's training on, I think, about 2011 to 2019, validating the parameters, so tuning the hyperparameters of the model, things like learning rate, um, on around 2020 to 2022, and then it's testing here starting in mid 23. So that's just one model. Maybe I got lucky with that time region. So a better thing to do is to train a bunch of models. So what I did here is grouped the data into 5 years. The first 4 years of the group is the training set. The next year of the group is the validation set, tuning the hyperparameters. First 4 years goes into the training of the model, tuning the weights of the model. And then the final year of the group is testing the model. How did this do? Actually, this is a bigger walk forward. So this, I believe, is training on 6 years, validating on the next 2 years, and testing on the final year. And so you see when I'm doing this, I'm still getting information coefficient. It's not as high as it was before, but sometimes it's higher. At its worst, it's still above 0.02, my goal. Also, the information coefficient to information ratio, my goal is to get above 0.3, and the worst it's performing is still above 1, so still over 3 times my goal. So this is the indicator that I have a really good model. So the next step is the final step for this first strategy. Basically, I'm just going to keep working on this indefinitely, fine-tuning strategies, adding more data for better strategies. There's a lot of things that I can do moving forward, but I want to get a first model working, and once I have the model working, I'm going to paper trade it for a month. This will be a test of, how does it work in real time. So I was having trouble getting a good portfolio strategy last week. That looks bad. The drawdown's really good. The worst drawdown was 3%, so that's really good. But the returns aren't really good. It's only about 17% return over 4 years, over 3 years. And so, 22, 23, 4 years. I'm getting like a 17% return. And so that negates my first goal. I could just buy and hold the S&P 500, which on average goes up 6% per year, and I could be outperforming this model, even though the drawdowns are really low. I tried another model, just a simple back test, equally weighting the stocks based on their predictions. That didn't really work well either. Now this morning, I got a really good strategy where basically instead of equally weighting the stocks, I'm weighting them according to their predictions. So the best prediction is getting more weight than the second best prediction, which gets more weight than the third best prediction, so on and so forth. So these are the model results. And this looks really good. So one thing that's really nice is it's only buying and selling. Let me pull up the code. So this is the code I'm using to run it. This is the code that holds all the classes. And so if you look here, you see it's only buying it's only going long on 5 stocks, and it's only selling short 5 stocks. And then it's holding them for 5 days, because that's the this strategy that I've trained it on. What else is interesting? Oh, the fact that it's only going long on 5 and short selling 5. That means that I'm not going to get a lot of slippage from transaction fees. I actually got, and the worst drawdown here is about 10%. So I need to look into, can I tolerate that? And that happened right here kind of recently at the end of 2025, which is a little bit concerning, but it's not the worst thing in the world. And you see the performance of the portfolio is really good. And so I'm going to look more into this today and see how can I, squeeze out some more performance. One thing that's really good is it's lowering the position sizing. So if there's some really high volatility going on and the market's hard to predict, I lower the position size. If I've recently had a really big drawdown, I'm lowering the position size. Um, because if it's not performing well, you don't want to be going all in with your portfolio. So this looks really good. Oh, but what I was going to show here is if I do, so that max drawdown was 10%, which is tolerable. But if I increase this to, instead of holding 10 total positions, I'm going to hold 40 total positions. Check out the performance. So the return is a little bit lower. Now it's only 60% return. The last one was giving an average annual return of 35%. So I've basically halved the return, but it's also way more stable. So now the worst drawdown is 4% instead of really bad drawdown of 10%. Actually, that's not even really bad, but you would rather have a drawdown of 4% versus 10%. So I could adjust how many stocks that I'm holding to squeeze some more performance out of the drawdown. It's basically a trade-off. The sacrifice I have to pay is that I'm going to get less returns. So that's kind of the trade-off. I need to figure out what kind of trade-off do I want here. Another trade-off is a big reason I'm getting less returns here. So 60% total returns versus, let's see what it is if it's 5. Oh, that's because I changed the holding period to 20. So holding period back to 5. Let's go long on 20, short on 20. Yeah, so the drawdown's 5%. But the profit is 80%, so that's pretty good. Now, if I go long on 20, let's try going long on 5. So back to this, short on 5. So there I'm getting an average annual return of 22%, total of 80%. Now the total is about 150%. The average annual return is 35%. The price to pay is that it's more volatile, and I'm dealing with much bigger drawdowns. So that's kind of the trade-off here. What else is going on? My intuition here is that the fact that the gross exposure is fluctuating so much is a good thing, but I'm not really sure of that. And you also see this as market neutral. So 2025, the tariff crash happened. So that was March and April of 25. So let's go to March. So March and April 25, you see, went up, went down, went up again. But I never suffered a big crash like the S&P did, or, if you were a normal trader, you would have suffered a bad crash. So I need to tune this strategy in, and I also need to check to make sure that it's not leaking, and I need to run this strategy on the walk forward results. So yeah, that's what I'm working on basically. Why is this guy frozen? it should use the volatility of the previous day to position the portfolio for buys at market open. It should hold the position for 5 days and sell at market open on the 6th day. Is this what's happening? I'm kind of worried it's not what's happening, but let's see. Two issues, uh-oh. Why is this glitching so much?